Why just moderately optimistic when it comes to equity? Some say, there's still a long way to go in terms of the write-up, and the losses, or rather the sell-off we saw last week, was a buying opportunity.
Yes, Haslinda, yeah, we are overweight. Just that the expected returns from here are just a little bit lower given the strong returns year to date. I think what's interesting is we had a 300-day period where the S&P did not have a 5% correction. That's the longest in 15 years. So we had roughly just over a 5% correction last week. So yes, we would be buyers of that dip. Seasonally, the returns are more moderate in the fourth quarter, though positive. So since 1950, in general, markets are up average 4%, the S&P, with about an 85% hit rate. So we're still overweight. We'll be buying the dip. Just our expected returns are lower, that's all.
What do you make calls of a taper tantrum? Not too long ago, people were saying there's no way we'll see that tantrum that we saw back in 2008. Now people are not so sure. Are you?
Yeah, we'd like to say it's a tantrumless taper. That's what we think will happen. We think they'll move relatively slowly. They telegraphed it in advance. They moved it up in the last FOMC meeting, likely to November. The payroll is the complete arbiter. We likely think that'll be the key. If that's a reasonable number, they'll move ahead. The pace is also going to, looks like they're saying middle of 2022 is a little bit earlier than expected. The first rate hikes could start in the fourth quarter of 2022. But overall, if you're looking at the level of negative real rates after inflation, it's still quite negative. So the market can handle it. While in previous periods, clearly it was not telegraphed in the way it is now, and the Fed's learned from that.
Yeah, absolutely. Separating the two, normalization of monetary policy and ending the bond program have been very, very deliberately separated by the Federal Reserve. But a lot, of course, as you already mentioned, inflation is going to be key. People are now questioning perhaps whether this word transitory or temporary is it going to be temporary inflation? The question is, how long is transitory ultimately here as well? And at what point does the Fed actually realize that they may have got it wrong?
Yeah, great question. In the short term, the transitory period is a little bit longer. If you think about what was worrying us a few months ago, it was used car prices, lumber prices. They've started to correct, but there's obviously new things. That's what's happening on supply chain, natural gas, and other prices going up. So what we think right now, based on what we're seeing, is that inflation peaks sometime early first quarter of next year, middle of 2022. U.S. inflation starts trending back down by the end of 22, back to around 2%. In Europe, probably by mid-2022. But that has been pushed out. We are in a different era compared to the previous regime, where wage inflation will be higher coming out of this recovery than previous periods. So inflation will be higher, but we don't think hyperinflation or in a case where the Fed will be massively behind the curve. But clearly they've woken up to the risk, and that's why they've moved up some of their taper language.
Just having a look at, you were alluding there to, of course, demand pull inflation. Everybody's concentrating on cost push inflation, i.e. looking at supply chain disruptions, higher energy prices, the cost of moving goods around the world, that sort of thing here as well. But will we see a move in real yields, as it were, and break in nominal and real yields anytime soon? Because we haven't seen them really match inflation expectations.
Yeah, we had a spike in March, real yields coming back up, and we've seen recently a moderate move, but inflation expectations, if you're looking out 5 years, have not moved up as much. But we do think there could be an increase in moderate in real yields next year. Why? What's the economic context? We still think growth will be above trend next year, though, of course, lower than this year. And given the supply chain bottlenecks, but more importantly, wage inflation and other factors, we should see some increase in real yields because real yields are just too low.
Prashant, how are you trading the energy crunch, which some say may last a few years? What's the risk of stagflation?
Yeah, what's interesting is the stagflation element is really what do you think about sectors? People that are price takers like consumer staples, utility companies with higher coal prices and natural gas, if they don't have the pricing power to pass it along, they're obviously going to be casualties, and we'd be more cautious or underweight those sectors. The sectors are going to benefit from this. Real assets is one of our themes. is clearly energy companies, EU energy companies we like, and then a 50% discount to the market. They have 15% free cash flow yields, and they don't reflect the current energy price environment either. What we think is we're not expecting $90 or $100 a barrel. That would depend on if we had a cold winter. It's possible, but not our base case. But the current pricing would justify higher European energy prices. So really look at it from a portfolio perspective on a sector basis, winners and losers, as we get some inflation, and in some sectors, stagflation.